To us, thematics exposures that capture structural trends, long-term structural changes, typically transformative in nature.
A thematic ETF to us is something that's thinly sliced, much more thinly sliced than a sector ETF, that stays within one industry or one group of industries that we define where they move in magnitude together.
That's John Van Moyland, Managing Director and Global Head of S&P Kensho Indices. He's joined by Samuel Rozzi, Manager of Due Diligence for American Portfolios. John Van Moyland comes to us on behalf of our sponsor, State Street Global Advisors, which we want to thank for bringing this episode of the Think Tank Exchange to life. We're about to talk all things thematic investing. I'm Michael Gayed.
I'm Dan Weiskopf, otherwise known as the ETF Professor. Welcome to episode 104 of the ETF Think Tank Exchange podcast. Thanks for joining.
Professor Weiskopf.
And hey to you, Mr. Gayed. It's good to be bringing episode 104 to our audience. This will be the last one of 2020. And man, I'll tell you, really looking forward to more live Think Tank Exchange shows and podcasts in 2021.
Yeah, for sure. And there's a lot more to come. If this is your first episode that you're hearing, first of all, thanks for tuning in. The Think Tank Exchange podcast is unlike any other. Our focus here is to provide thought leadership by bridging the gap between investment products and the advisors which use them through actionable ideas in real-world scenarios. Our discussion here is meant to provide some color around our experts' commentary.
We've got color, all right. Also, we invite listeners to visit etfthinktank.com for many more insights.
Well, as mentioned, we're talking about thematic investing, so we're going to toss it back to the live show where our guests, John Van Moyland and Samuel Rozzi, along with Mike Venuto and David Chikansky, put some definition around the category.
So we're going to get right into it and go right to the most important question, which is, what is thematic investing? And I'm going to first define it from what we do in the ETF think tank, right? Because it's a hard thing to define, right? And we've looked at it as any index or ETF that is not 80% in a single sector, but is looking to capture a overall thematic trend and can go across global and sector allocations. So that's kind of a boring bookworm kind of definition. Sam, we'd love to hear your definition as an actual practitioner using these sorts of things.
A thematic ETF to us is something that's thinly sliced, much more thinly sliced than a sector ETF, that stays within one industry or one group of industries, and that we define where they move in magnitude together. So things that are different than just a normal sector ETF, where we're not getting too much overlap with different business models.
Yeah, and I think the commonality you're hearing from both of them is that there's kind of unique characteristics. John, we'd love to actually hear your viewpoint on what makes like a thematic ETF a thematic ETF.
To us, thematics are sort of exposures that capture structural trends, right? Long-term structural changes. We don't think of it as a short-term sort of idiosyncratic activity that may be going on. That may be a political sort of lens or some other kind of lens.
So, Sam, why don't we go back to you then and talk a little bit about how sectors are different than themes? I've always found defining something new is best to do by juxtaposing it to what everybody's comfortable with. Obviously, exactly. As a practitioner, how do you think about sectors versus themes?
So I think you're not really diversifying your broad-based exposure when you're using some of these sector ETFs, whereas thematics, I can go through a list of different thematics: solar, clean energy, genomic sequencing, fintech, Internet of Things. But the beauty of thematics is Yeah, so in clean energy, we have sub themes as well as the overall theme of clean energy of wind, solar, and you do see some dispersion. So in our models, we actually split that up where we wanted to get. We analyzed the overlap. We saw that it really isn't something. We're still providing diversification by being exposed to both of those themes, and we opened our model up to allow investing in both of them.
So 9 Points is putting their thematic portfolio together by use of momentum. John, we'd love to hear how you're structuring your overall thematic ETF and encompassing all the underlying themes that Kensho has.
It's a fairly dry question, right? But we actually spent quite a lot of time developing a framework so that we could actually answer that question in a sort of rigorous and transparent way. So we did a bunch of research looking at a whole set of prior industrial revolutions and other periods of significant structural change to the global economy. And we identified innovation patterns that are consistent for the fourth industrial revolution, right? And then you overlay essential economic activity, and that allows us in a very sort of disciplined and sort of predictable way to identify these areas of exponential innovation. So I think that's a really important part, because otherwise it's all about media momentum, right? It's like what's the media talking about, and that's what people gravitate to. Whereas if you've got a framework that's actually founded on some sort of some discipline, intellectual integrity around it, then you can be much more confident that the actual transformative trends that you're focused on actually have some basis in reality, right? They actually have some basis in underlying innovation.
This was a great exchange for me, as it highlighted what I've been speaking about for a decade or so. Like a broken record, I keep saying how structure matters, and both John and Sam made it clear that innovation is about diversification, delivering alpha and capturing trends with industry disruption. Moreover, I found that this was an exchange that highlighted that investing in markets is no longer about being passive, about targeting growth. I think the money flows in thematics this year have been for good reason and are a long-term trend. Investors want to identify what they believe will deliver growth. Defining growth simply as a factor is less appealing than identifying a trend that is understandable. The fact is that investing in growth in 2020 became personal.
Yeah, and certainly beyond sort of the constructs of just standard traditional sectors, as we've seen. I think the point being made about technology going beyond the tech sector into areas like finance, into areas like energy, I think kind of highlights the point that we have to think differently about how do we categorize our investments, how do we identify trends, and doing that through the thematic lens is probably a longer term trend that we should pay attention to.
Let's get back to the live show and how to evaluate themes. Our own David Djansky, portfolio manager at Taroso, leads off. Venuto explains why.
And I'm actually going to start this by sending it to David, because we do a lot of work on the ETF think tank in helping people look at these and how to think about them. But David, why don't you start to answer that? And then I think we should go to Sam, since they're also a practitioner of thematic investing.
Yeah, I mean, it's hard to subscribe one evaluation process to all thematic ETFs, but I think overall, really what you're looking for is true growth, right? So the way we define that as simple as possible at Taroso is just the PEG ratio, right? How much are you growing into in the next in 3 to 5 years, right? For companies that might still have margins problems at that point, you might be looking more at market share growth and how much of a market share could they potentially gobble up in the next 5 to 7 years. And then after that, you're looking at, again, construction of the vehicle, how it's rebalancing. Some of these spaces trade positions that can pop and have popped, 20% 2 or 3 days in a row and waiting for a quarterly rebalance. Maybe dependent on your weighting size, right? Kind of equally weighted index might have less of a problem with it, but if you are market cap weighted and some of those larger names are still small caps and they're popping, and all of a sudden you might have exposure at 19 to 22% on a single stock waiting for that quarterly rebalance. So I think really understanding what you're getting from a deep level But Sam, we'd love to hear a little bit more from you on that as well.
Yeah, thanks, Dave. There just weren't that many available options going back 5 years ago, but looking even further back to 2007, I mean, you really had home builders, MLPs. It just wasn't a space that you were really able to make these types of decisions in yet. So with these new issuances coming out, it's made it so much easier, and there's actually some data to go through and try and figure out, okay, what makes sense here, what doesn't. And I think an important thing about the PEG ratio when you are looking at this is that it's accounting for the price of those ETFs already, because I think that's the most important thing that I see with advisors all the time, where they're getting into a great theme that's growing in a really big way, but they're doing it late because it's already out. I mean, you're already seeing it in the price. And then, like I said previously, you're just raising the risk of your overall portfolio on that, and that really is probably the biggest thing to avoid as a retail advisor if you're going and allocating it in that way. So yeah, what we do is we like to have a risk-weighted portfolio based on momentum, using momentum as the leading indicator, making sure that when we see people allocating to these themes in a big way, we allocate to them as well, and we do it in a risk-managed approach where we know we're not putting too many eggs in one specific basket. We do that with our overlap analysis, making sure that actually the underlying equities we're not owning too much of. And to another point that John made, we find that we're not really that over allocated to the mega caps. So at any given point, our strategy trades weekly, so there really is a lot of turnover there. But the mega caps don't tend to float in. You're seeing some of these smaller players that are gaining market share pretty rapidly that have those outsized allocations compared to indices, because you're just seeing tiny allocations in the broad-based indices, and those are our true overweights, and that's really where we're seeing our positive relative returns from finding those companies and doing that through the ETF lens, which I think the ETF lens is the perfect way to do it. Just because of tax efficiencies and others there. But yeah, right now we have 65 unique investable themes in our universe, but about 110 that go across different, that say there are multiple clean energy ETFs, multiple esports ETFs, but 65 unique themes. And the biggest thing to focus on when you're doing due diligence is that you're not over allocated to any one sub theme or any theme of themes that's allocating heavily to a sub theme that you have. Because again, that's the biggest thing, the biggest problem I see when I'm looking at proposals, current accounts, trying to figure out, okay, how should I make this allocation a little less risky, maximizing risk return possibilities? It's you have advisors that either haven't hit the rebalance button on their portfolio because 2020 has accelerated these themes in such a large way, in a way that really no one predicted prior to COVID. So then you have positions floating up to very, very high levels, again, really exacerbating the amount of risk in the portfolio. And something that we like to do is, and why we like the weekly rebalance, is because it does bring that back in the line, and you're forced to enforce that diversification in your portfolio, and you're forced to manage the risk of your portfolio by making sure it's in line. So that's really how we like to look at it.
So, John, you just heard the consumer of the cake explain how they look at it, right? The momentum, the pegs. We would love to hear, as the producer, as the baker, when you guys are looking at these positions and looking at exposures, are you completely devoid of thinking about valuation metrics, or do you create new types of valuation metrics? Right? Everybody's excited about themes, but very few know how to evaluate them. So, as the baker, what should we be thinking about here? Is it sugar? Is it allspice? What are we putting in?
Well, I love the analogy, but I'm not a great cook, actually, so I'm going to stop right there. Look, we don't look at valuation. I see our job is to provide you the most comprehensive and the most precise lens with which to understand particular exposures. The reality is that each of these areas go through their own, as I mentioned before, their own gestation. There'll be periods when they may be relatively undervalued or overvalued or whatever. The bottom line is have you correctly identified what that exposure is? Have you correctly described it? And have you correctly identified the companies that are driving it? And that's where we focus our time. I mean, what I will say is what is interesting is I look across the new economy, and these are slightly dated numbers, but so these are end of Q3, but if I look across those 400 companies in the new economy in aggregate, some of those sort of valuation metrics, such as things like price to book and so on, they are running below the S&P 500. You look at things like EPS growth, whether it's 1 year actuals or 3 to 5 year estimated, and you're talking about, in some cases, a sort of 30 to 50% upside or premium to the new economy's names, which is really interesting. This is, when you're talking about these sort of innovation, growth-oriented strategies, it's interesting that they're actually on some of these valuation metrics, they're cheaper than the market, and yet they've got more growth potential than the market would seem to reflect, if you consider the market being the 500 as an example. That's not driving our work. Our work is about giving you the most comprehensive and most precise tools with which to understand what's going on, what is this disruptive innovation and disruption to the global economy. And then from there, we've got the likes of Sam who can really do the baking to make sure you've got a palatable cake.
So I kind of want to close this section on evaluating themes with just letting everybody know, beyond the traditional valuation metrics and things like that, within the ETF think tank, we've built tools that Sam and other members have used that let you look at the overlap, calculate the cost of the active share, understand the concentration. We recently wrote a piece about, concentrated themes being used for short-term trades, whereas more diversified ones being used for compounding, especially when you're comparing two funds that purport to get the same thematic exposure. So from that, anybody interested, obviously you can always check out etfthinktank.com.
Dan, one of the things that I particularly liked about this section here was the focus by John Van Moyland on the idea that you're going to have these gestation periods, or you're going to have these periods where things are overvalued, undervalued from a thematic perspective, and that these themes are not necessarily fads, that they just go through their own cycles. Maybe provide a little insight on kind of your experiences living through some of these over time.
Yeah, you're just reminding me that I'm the old one on the team, right? Yeah, no. Having lived through some of the cycles, what I found also important was how John at S&P Kensho focused in on 25 subcategories. I don't think that people fully appreciate that some of the structures that exist today with the sectors are market cap weighted, and so they're not always adapting fast. I found his comments on that really, really interesting and important. And to that point further, one of the things that he pointed out was how 45 to 50 million Americans will need to change occupations by 2030. I mean, that's staggering when you think about that, and that leads to different themes, right? Grabbing all these companies, as he said, at the early stage of growth will be important.
Yeah, absolutely, and that makes me nervous for our own future in this industry. Everyone is need to reinvent themselves in a fast changing environment. Let's go back to the show and talk more about how to use themes in a portfolio.
Sam delivered some similar key points when he highlighted all the choices that are available today. Moreover, what I also found noteworthy was how Sam highlighted that it's all about diversification of risk. I think he used the term diversifier of diversification, and how things are not overlapping as much. Sometimes I think the expectation with thematics is that they might zig when the market's zagging, or put differently, he seems to be using thematics as a core and explore allocation, which is a term we often use in the ETF think tank. He's also a little bit like a kid in a candy store in that he was excited about so many different themes and, again, personalized how thematics can be used.
All right.
Once more, we'd like to thank State Street Global Advisors for sponsoring this podcast and the live show.
I want to move to the last section for today, which is how do we use themes? And, let's start with the biggest question that everybody always asks, and I've been asked it on a million portfolio reviews. Where does this fit in my portfolio? So John, let's start with you. Somebody comes to you and says, I've got my traditional 60-40. What do I peel off and put into a thematic allocation?
Well, we wouldn't provide investment advice, of course, but what I can do is share, and I think this illustrates nicely, actually, some examples of clients of ours and how they use it. So we have a client who's outside of the US, actually, who runs a superannuation fund and a retirement fund, and they have a 10% allocation to the composite within their equity sleeve. And their rationale for that is this represents the most innovative companies driving the next wave of change. You must have access to it. So they've treated it in that case as part of their core. It's not a satellite to that. And then we have other clients who have an innovation sleeve or they have a growth sleeve, and they are looking to look at these kinds of thematics to make that up. And typically they will be, I've seen them have an array of providers, an array of different perspectives. I think, one of the key things that has been alluded to is that thematics, by their nature, but also by the fact that it's still a young space and there aren't accepted definitions or frameworks, there are a whole variety of different ways of accomplishing these things, can look very different under the hood. So, while the names may seem like they should be equivalent, when you look at actually the makeup of it, it's not just the weighting, it's actually the core fundamental exposure is just very different. That's something to bear in mind. But I hope that gives you a sense anyway of the sort of the two main areas of use cases that I see our clients use: core and then satellite.
No, that's great. And I think the important message there is that you have kind of a target allocation and you monitor that, right? And that's kind of a common message we heard from Mike, Sam, and John, right? That these things can float, and that kind of a balance is just as important as what you're doing within your sleeve. Sam, could you talk a little bit more? It seems like more and more tactical allocators across the board are moving more towards using thematic ETFs versus some market cap and sector ones. I know you touched on it briefly on the onset of the call, but if you could touch on it a little bit more now, that'd be great. Thank you.
Yeah, and I think it really goes back to the very simple point of you want your core and you want your satellite. This tactical thematic piece is more of your satellite. Why do you want them to look the exact same when you're risk on? It doesn't really make too much sense. You want it to look a little different. So I would say the traditional where you have an on-off switch. Let's just be very simplistic. On-off switch into the S&P versus cash or short-dated treasuries. Yes, you're going to be sitting in cash for extended periods of time, and then when you're in, you're just seeing broad-based returns. What's so interesting about adding the thematic piece, and it's something that hedge funds have solved in the tactical space, but it's been really difficult to solve in more of the retail side, is how do you get that extra risk, that extra level of risk and extra potential return when you're going to be sitting in cash for some period of time, or at least sitting in defensive assets that you think will do good in times of equity downdrafts. And that's what allows you to potentially keep up with those broad-based indices, because you see a year like this year where you have a true acceleration of themes, and that really buoys the return up. Obviously, it goes the exact same way on the downside, and throughout our back test through 2007, it's why the return stream looks absolutely nothing like any equity index that's out there. And it's because you see times like now where these types of thematics, I'm speaking very, very generally, well, let's just say genomics, esports, pets, some things that are definitely going through some growth cycles here. And you see a rapid advance followed by a pretty long shakedown period where you can get bogged down with poor investment returns and little growth that isn't priced in for long periods of time. So I just think it makes sense. Again, diversify your tactical bucket. Your clients will probably have that traditional asset allocation somewhere in 401k, somewhere in their total net worth. This is where you're able to go there with a story. You're not just selling the basic strategy. You're selling something that's innovative. You're seeing a gigantic explosion in assets in the space, and it differentiates from you and the guy next door.
John said it well. It's the rate of change that matters. And of course, David pointed out that at Tarosa, we focus on the PEG ratio. John and Sam both honed in on how disruptive trends are occurring across industries. I found his point about measuring the life cycle in each growth area and his narrowing of the choices to 400 companies an important institutional type of analysis.
So, Dan, kind of echoing on that point, on the rate of change and growth, I think it's important for everybody to realize that the future is always changing, and that you've got to constantly try to reevaluate different themes and different areas and try to rethink about your portfolios to try to find that which is accelerating at the fastest rate, not in terms of stock price movement, but actually in terms of broader macroeconomic and growth variables, right? So I think that reminder that you've got to be on top of these things and not just sort of allow the runaway theme of the moment to take control of your thinking is really important to really having a dynamic tactical mindset with a portfolio.
You're exactly right, Gayad. And life is dynamic, and maybe your portfolio should be that way as well.
Uh-huh.
And every live Think Tank Exchange show, we ask our advisor guests to highlight a charity. Here's Sam.
Yeah, so speak a little bit about World Team Sports. It's a charity that gives back to veterans as well as wounded veterans by putting on various challenges around the country. So I've been a part of a 110-mile bike ride, 3 separate occasions, which sounds great in theory until you're on the road day 2, 5:30 in the morning, pedaling away. But really, what brings you back every year is just seeing the unison between both the veterans, the civilians that are there. You have the road shared with hand cycles as well as regular bicycles. I'm not a bicyclist by any stretch of the imagination, but I'm always upset and saying, oh, this is a lot, until the second I get to the finish line. And I'm like, this is just such a great event. And then you spend the entire year waiting for another. So that's not the only one they do. They put on a lot of great events like this, kayaking, hikes, things like that. So I just think it's a great cause.
Wonderful. All right. So with that, just a few more quick logistics. If you want to learn more about the Kensho indexes and the processes, please visit the State Street Global Advisors and learn more about what they're doing there. And with that, I hope everyone has a wonderful holiday season and stays healthy. Thank you.
Lovely.
Thank you all.
Thank you.
Thank you, everyone. Take care.
As we wrap up this episode, we'd like to thank State Street Global Advisors for sponsoring this podcast and the live show. Join our live Think Tank Exchange show by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
That's because our value proposition is to enhance yours. I'm Dan Weisskopf.
And I'm Michael Gayad. Be well, thanks for joining, and we'll keep the exchange going in the future.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.